Hello, everybody, and welcome to another episode of All Things Awareness. Thank you so much for tuning in once again. Before we start, I just want to give a disclaimer. In this channel, we are not providing financial advice. For a more personalized financial advice, please speak to your financial advisor or your financial planner. All right, let's get right into it. So in today's channel, we are going to talk interest rates. Yes, interest rates, it impacts everybody, but let's see how it affects you. So today we're going to speak about the four main types of interest rates. Remember, when it comes to interest rates, you have subcategories of interest rates. But for the purpose of this video, today we are only going to speak about the four main interest rates. Right, so the first one is the repo rate. The repo rate is the rate at which the central bank, in this case, that would be the Reserve Bank, lends money to the commercial bank. Your Absa, Nedbank, FNB, those are your commercial banks. The rate is currently at 7.5%, and this rate is normally on a variable basis. This rate affects commercial banks as well as organizations that depend on the Reserve Bank for funding. The question then becomes, why would a commercial bank lend money, or why would a commercial bank borrow money from the Reserve Bank? Yes, banks do borrow money from Reserve Bank. Banks are also indebted. All right, so these are some of the reasons why a commercial bank would borrow money from the Reserve Bank. So there is many reasons as to why they would do that, but today I'm only going to give you three. So the first one, the Reserve Bank requires each and every commercial bank to have a bank account with them. And on that bank account, they have to keep a certain amount of funds in it. And that balance cannot go low. Once that balance starts going low, then that commercial bank goes and borrows more money from the Reserve Bank just to keep it at that specific balance. Just like when you have your bank account, for instance, on your payday when you get your salary, your balance is high, or if a payment comes through, if you're in business, your balance is high, then you obviously utilize those funds, you pay this, you pay that, you purchase here, debit orders go off, your balance starts going low. The same happens with the commercial banks when it comes to the Reserve Bank. The second reason would be for them to pay whatever they owe and for them to have extra cash. Remember, it is very risky for a bank to run low of funds just because of their business model. It's very risky. And the third one would be because of the decisions of the central bank. If, for instance, the central bank decides that they're going to increase interest rates, that will affect how the banks borrow to pay back and how they lend to their customers. That will definitely affect. So when interest rates go up or they go down, it does affect commercial banks. And as a result, that also affects how they borrow, how they lend money to their customers. Right. So these are some of the reasons why a commercial bank would go and get and borrow money from the Reserve Bank. And the second one is the prime lending rate. The prime lending rate is the rate at which the commercial banks lend to their credit-worthy customer. This rate is currently sitting at 11%. And this rate affects both individuals and businesses. You would normally hear, people say prime plus or prime minus. What that simply means is that if you have, when whatever interest rate that was allocated to you, if it's more than 11%, it means that you're on prime plus. If it's less than 11%, it means that you're on prime minus. So just something, that is very interesting. In the US, their repo rate is currently at 4.25, 4.25, and their prime rate is at 7.50. This basically means it's much more expensive to get credit in South Africa, compared to the US. And as a result, when these things happen, as a result, you find that credit providers, they try by all means to manage the financial risk. Some of the things that they would do, just to manage the financial risk, they would increase the minimum, income requirement, or they would tighten their credit policy. Let's use a credit card as an example. So if you, for instance, want to apply for a credit card, and the credit provider will probably maybe say something like, you need to earn 8,000 rands in order for you to be able to qualify for this credit card. So if you earn 4,000 rands or 5,000 rands, anything less than 8,000 rand gross, it means that you do not qualify for that credit card. I mean, let's take housing, for example. There's a certain amount that you need to earn gross income. And if you don't earn that much, it means you cannot qualify for, for a house in that, with that particular credit provider, be it a bond originator, a bank, whatever the case might be. They would put in standards just to manage the financial risk. Speaking on financial risk, we're going to have a whole series on financial risk. So please do subscribe so that you do not miss out on that. That's it on the prime rate. If you have anything that you would like me to further elaborate on the prime rate, let's meet on the comment section. And the third one is the fixed interest rate. So basically the fixed interest rate, this is what happens. When the central bank increases the rate, you retain your interest rate. If they decrease, you retain the interest rate. Let's put this in perspective for you. All right. So for instance, let's say you have a investment account, and on that investment or a savings account, and you got a fixed interest rate of 8%. When rates go up, you lose the benefit of an increment on your interest rate. When rates go down, you basically, you're basically secured because your rates will not go down. So that's basically the interest rate. When it comes to credit, though, if you have a credit product and if your rate, let's say with your home loan or your vehicle finance, they fix the rate at a specific rate. If interest rates go up, then you're actually good. You don't have to worry about your installment going up. But if the rates go down, you lose on the benefit of a decrease on your installment. Okay, so that's basically in terms of rates. But one thing about credit products is that a credit product is normally on the variable interest rate. If the credit product is fixed, it will be fixed at a higher interest rate and at a shorter period of time. And this is basically just to manage the financial risk. And the last one, it's the variable rate. It's self-explanatory. So variable rate, if the Reserve Bank increases rates, your rate goes up. If they decrease, then your rate goes down. One thing about interest rates is the fact that interest rates are quoted on a per annum basis, on an annual basis. Let's use the investment again as an example. You have an investment account, a savings account, and your interest is 8%. What that basically means is that you take that 8%, you divide it by 12. So per month, you are earning an interest of 0.67. And with credit, let's say you have a personal loan and your interest rate is 21%. You divide that 21% per month, you are paying interest of 1.75, something of that sort, 1.75% per month. Now, just reflect on the information that I just gave you. You earn interest of this much and you pay interest of that much. And if you watched the borrowing war with everything else that comes with credit, you have having to pay back the interest, having to take into account all the costs that comes with credit. Is unnecessary credit really worth it? That's a question for you to answer. All right. So out of the three or out of the four, which one affects you the most? You're basically affected by all of them. It's just that with the repo rate, you are indirectly affected, but you're basically affected by all the rates, prime rate, fixed or variable rates. And that's basically what we have time for today. Thank you so much for watching. If you find this content, helpful, do comment, like, share, and subscribe. If there's anything that you'd like me to clarify based on today's episode, or any questions that you have for me, please let's meet on the comment box. Up until next time, be aware and thrive. Thank you so much. My name is AQ. See you on the next episode. Don't miss out. Goodbye.